Let me start with a question. The UK has one of the worst levels of investment in the OECD, yet has the second largest pool of investment capital, over £5 trillion. How can that make sense? The answer is that the UK investment system, which takes money from savers, transmits it through financial institutions into the real economy, is broken. This system is vitally important to the UK economy. Our health, transport, education, food, energy, technology all depend on investment. And the way we finance these systems affects the sustainability of our environment and planet. So I'm going to tell you about New Capital Consensus' approach to fixing this broken system. What do I mean by the investment system? Well, at the top you have UK savers who provide the bulk of the money, and at the bottom you have the UK economy. Money moves through the system by pooling savers' investments, either in defined benefit or defined contribution schemes or retail investments. And at the bottom, companies access capital by issuing securities, public, private, governmental, or debt or equity. And in the middle, you have asset managers who match investment pools to securities. Companies make money on these investments, which in turn goes back to savers, producing a healthy returns for them and a healthier economy for us all. Of course, the UK doesn't operate in isolation. We attract foreign capital into our system, and that's great. But there are very high levels of leakage out of the system. Well, so far, so simple. However, unfortunately, our research has found that the UK investment system doesn't actually work like that in practice. It's broken. Right now, it's not working properly. It's not fit for purpose. Working with Leeds University, we've developed a unique quantitative understanding of how much money is in the system and how it's been invested. These little icons represent the stocks, and we've conducted 45 qualitative interviews with participants right across the system to understand the incentives that drive money through it to different places. And these are the three key issues we've identified. Number one, the funds within the system are heavily fragmented, especially in defined benefit schemes, where we have 5,000 sets of trustees managing £1.2 trillion of assets. This is hugely inefficient and results in uniform investment strategies and industry herding, which leads to high levels of systemic risk. For example, we have calculated that the loss in assets from the LDI crisis was some £650 billion, driven predominantly by accounting practices and regulation. Number two, regulatory requirements and market expectations for liquidity means that much of the DC and retail money we have is invested inefficiently. We give long-term savers short-term access to their funds that they don't in reality need, and that costs them in returns. Number three, and perhaps most significantly, the system directs money to the wrong places. Where exactly? Well, three places. A large amount goes into gilts or gilt-like instruments like LDI that doesn't create productive capital for UK business. A lot goes overseas because of the way we construct investment mandates. And the rest largely goes into secondary investment, trading in shares and bonds, which is all very well, but this doesn't grow the real economy. As John Kay pointed out a decade ago, UK public markets no longer put net new capital to work. Only a tiny amount of money is actually going into primary investment to build companies, create jobs, improve infrastructure, and support a just transition here in the UK. In summary, we face three big problems: fragmentation, short-termism, misdirection and leakage of money. And one other thing, but a big thing. There are almost no incentives within the system to make returns. We've looked hard, we just couldn't find any. And since returns equal economic growth, we shouldn't be surprised we don't currently have any. So what are the solutions? Well, New Capital Consensus makes these 5 initial recommendations. Number 1, consolidate pension funds. £1 in every 5 is in the private DB sector. Let's ensure it's invested more productively by tackling fragmentation. And I know this is controversial, but we should start by allowing life companies to set up super funds outside their Solvency II ring fences, alongside new providers of capital. Super funds must operate under pension scheme regulation, which will enable them to do more primary investment, more investment in real assets. We know what to do, and we can act on this fast. Number 2, sort our obsession with short-term liquidity. We're not doing anyone any favours, not savers, not businesses, not the long-term interests of the UK. We need to remove the requirement for daily liquidity in the DC and retail markets. Number 3, change the system risk culture. We need to start by freeing up investment strategies and support institutional risk sharing with clients by changing regulatory and industry risk measurement. That means weaning ourselves off our unnatural fixation with volatility and liquidity risk at the expense of duration risk and risk to returns. We must extend investment durations where we can and reduce unnecessary de-risking, and develop new skills and techniques around long-term investing and liquidity management. In particular, we must construct better investment mandates. We must encourage DC schemes and retail to seek investment returns rather than just low costs. Number 4, let's make sure we direct more money into the UK economy by introducing tax incentives at the asset level, not just the wrapper level, to boost the appeal of UK productive investment, encouraging savers to invest in the UK and the communities in which they live and will most likely retire. Re-establishing this social contract between savers and wider society is crucial, and an appropriate quid pro quo for the valuable tax incentives society provides savers with. Finally, we need a new type of oversight of the investment system. It has failed over a very long time, contributing to economic stagnation. We need new oversight. Those who regulate institutions cannot oversee system effectiveness. It's just too much of a conflict. We know nobody wants more regulatory change, but the investment system is fragmented and disjointed. It's focused on yesterday's problems, not today's challenges, and it's costing us the economic growth we need for a just transition and better outcomes for us all. It cannot deliver the reforms we need. It needs change. So to sum up, our investment system is broken. If we want to address climate change, if we want to level up society, if we want to reduce intergenerational inequality, and if we want economic growth, we have to change this system. Sticking plaster and silver bullets will not suffice. We don't get the outcomes we need because we direct money to the wrong places. That happens because we manage risk and liquidity badly. But the message of New Capital Consensus is that this can all be fixed. We know what needs to be done. 3 problems, 5 solutions. The investment industry, the people we've interviewed, all know what needs to be done. People across the city know change is needed. Let's work together to bring about this change. Thank you.